The Fed rate cuts were supposed to reduce rates by 50 basis points at the Federal Reserve level, which then should translate to a rate reduction at the retail level. That's us borrowing on our credit cards, auto loans, buying houses, right? Us as consumers. What actually happened, Federal Reserve dropped rates by 50 basis points, which is 0.5%. And what actually happened is Treasuries did not go where they were expected to. So the 10-year Treasury note. So usually, if the Fed makes one move, the Treasuries make a move that's in lockstep. They can expect a response from Treasuries. Treasuries actually went the opposite direction this time. So what we saw is instead of rates going lower for consumers, for us, for our houses and cars and credit cards, we saw rates go up. That was unexpected. And the Federal Reserve for sure didn't expect that either. So where does that leave us? And why? The first why is that most investors had basically baked in a rate cut already. So that 50 basis points, that 0.5% rate cut that occurred, most investors had already bet on the market with that in mind. They just said, yeah, for sure. And that pricing was already in the market. And assets were already repriced to that. Now, we don't have any adjustment in mortgages. We don't have any adjustment in rates because the market already made the changes that they expected. The issue today with why we don't see rates dropping is because it's still a very strong market. Usually the Fed drops rates when they see bad things occurring in the market. They see a potential recession or unemployment numbers going really high. What we're actually seeing is strong, resilient economic numbers. So now the whole market's like, well, if everything's fine, we're not going to reprice any investments. We're not going to expect anything different from the Fed. And now there's discussion if the Fed's even going to lower rates at all anymore. So my bet on the whole equation is that the Fed will continue to lower rates slightly, but I think us as consumers, we're looking at about a 6%-ish mortgage rate for the next decade plus. That's where this all shakes out. If you look at inflationary pressures on the way up, Fed dropping rates slightly, still strong economic indicators. The rest of the world not doing anywhere near as good as the US. So the US is still the safe haven for investing worldwide. I think we still have a strong economy behind us. And with manufacturing coming back to the US, I think it really balances out the consumer economy of the US with more of a manufacturing base. I think we have an even brighter future ahead with that in tow as well.